An options contract is a financial agreement that gives the buyer the right, but not the obligation, to buy or sell an asset at a specific price, called the strike price, within a set time frame. Options are commonly used for hedging risk or speculating on price movements. How do options work? Options are derivatives, meaning their value is based on the price of an underlying asset, such as stocks, commodities, or indexes. Each options contract has key components. Underlying asset, the asset tied to the option, such as a stock or commodity. Strike price, the price at which the asset can be bought or sold. Expiration date, the deadline for exercising the option. Types of options. Call options. Gives the buyer the right to buy the asset at the strike price before the expiration date. Example, you buy a call option for a stock with a strike price of $50. If the stock rises to $60, you can buy it for $50 and sell it at $60, making a profit. Put options. Gives the buyer the right to sell the asset at the strike price before the expiration date. Example, you buy a put option with a strike price of $50. If the stock falls to $40, you can sell it for $50, profiting from the price difference. Key benefits of options. Leverage. Options allow you to control a large amount of the underlying asset for a fraction of the cost. Risk management. They can act as insurance, protecting against unfavorable price movements. Flexibility. You can profit from rising, falling, or even stagnant markets, depending on your strategy. Risks of options. Time decay. Options lose value as the expiration date approaches, especially if they're not in the money. Complexity. Options trading requires understanding various factors like volatility and time decay. Potential for loss. If the option expires worthless, the buyer loses the premium paid for it. Real-life example. Imagine a stock currently trading at $100. You buy a call option with a strike price of $105 and a premium of $2. If the stock rises to $110, you exercise the option, buy the stock at $105, and sell it at $110, profiting $3, $5 gain minus $2 premium. If the stock stays below $105, you don't exercise the option and only lose the $2 premium. Quick recap. What is it? An options contract is a financial agreement giving the right to buy, call, or sell, put an asset at a specific price within a set time. Why use it? Options offer leverage, risk management, and flexibility. Key risks: time decay, complexity, and potential for losing the premium. Options are versatile tools for both hedging and speculation, but understanding their mechanics and risks is essential before trading.